The internet's premier restoration business podcast. Let's go with Gokul Padmanabhan, a thoughtful listen on creating your business legacy. Your leading source for selling your restoration business. And now your host and America's #1 restoration reseller with over $500 million in restoration businesses sold. Here's Gokul Padmanabhan.
Hey everybody, welcome to our summer series of Squeezing the Most Out of Your Business. Today is episode number 4 from our one and only Phil Rosebrook from Business Mentors. We had dropped some great nuggets, Phil, in the last 3 episodes. We talked about cash flow, we talked about P&Ls, we talked about scheduling, planning jobs, deposits, AR, AP. I mean, we went through a lot, right? And this is the final episode, so I'm going to save the diamonds for, there's no more gold nuggets. We're going to precious metals now, diamonds, okay?
All right.
We were just talking before we started recording here on arguably the most important number in your business from a financial perspective and squeezing more margins, which is your net income.
Yep.
Right?
It's interesting, yeah. We also discussed that it's tough to spend net profit. It's tough to spend it because it's just a number on a ledger, isn't it?
Sorry, I meant to say net profit, not net income. So it's really interesting, right? We could look at numbers on a P&L, and the business may be showing a lot of profit, but are you really squeezing all the juice you can out of it? And is it a real number? What are your thoughts?
So let's go a couple things. I mean, we're going to talk about net profit. We're going to talk about maximizing that number because I think it's important. But I think the relevance I want to talk to you about at first is I work with a company up in Canada, and I say Canada because I want an asterisk on this. Their turns on receivable was over 100 days. And it's because of the way the market up there works. And we can get our turns on receivables here in the States down to a much, much lower number. And I think effectively, 30 to 45 days is a number that's achievable. In Canada, it's just not. And so here was a company that was really pushing good net profit numbers. I mean, it depends on your perspective. For that market, it was a good number. And they had over 3 years of profit sitting in accounts receivable. They were a cash poor business because of the way the insurance companies pay their bills up in Canada. So that being said, if all we're doing is focusing on net margin, we could fool ourselves into thinking that we have lots of money that we can go spend. And so I think the numbers, understanding how your P&L work, your profit and loss statement works with your balance sheet, because your balance sheet is going to tell you where the numbers are. And so you can have lots of profits, but then you have to subtract off your balance sheet numbers, which are your accounts payable, accounts receivable, your loan repayments, your asset purchase, everything else. And so you can find a company that's profitable that has no cash. So that's probably another long subject we won't really get into, but go ahead.
I can picture this, right? You can look at an owner taking a P&L and looking at the revenue number and looking at the profit number and then closing the books, and they're gone to their next job.
Right. Happens a lot, doesn't it? Happens a lot.
Right? Well, why is that probably not to their best interest of just looking at the P&L?
Sure. So there's a couple of things. I mean, the first measurement that a lot of people have, and it gives them a lot of esteem, is looking at revenue. And people look at revenue, and they look at assets, and they look at employees, and they say, gosh, don't I have a great company? When in fact, they have no cash in the bank. And so the real metric is net profit and positive cash flow. So if you find that the only way to grow your business is to have this huge bank line and have all your profits tied up in somebody else's account, when you end up in a world like today where your interest rates went from 0.5%, and this is Fed rates, but they go from 0.5% to 5%, which means that a bank is charging a couple points over that if you have good credit. that's a pretty big adjustment on the cost on your P&L statement, and where adjustment in the profitability of your company. So the first thing I'd say is it's important. It's
Adjustment
nice to
how, Phil? I
know.
mean, for those who are not familiar with it, let's dive a little deeper into it and kind of pull the curtains back.
Okay,
Why would
okay.
running a business out of line of credits hurt your margins?
Okay. So first of all, it hurts the margin, it hurts the health of your company. So it hurts your margins just because you're going to be paying interest for every dollar that you borrow. And so that's just cash out of the company, and it's a cost to your company. I think the other part about it that I look at is the is just when you have debt, you are beholden to somebody else. And if everything's great and you're growing your business and you're profitable and this is fantastic, and I'm just managing and measuring I'm managing my float with the bank's money. Okay, hey, that's great. It's leverage money. It's great until things slow down, and inevitably they're going to slow down. They just always do. We're going to have a bad month, a bad 3 months. That's okay. But if all we have is we have a lot of debt out there, now all of a sudden maybe we weren't making money for 3 months, and we're trying to figure out how we're going to pay back our debt, and that's just a scary place to be. And it
Yeah,
also it minimizes the value in your company. It increases the risk. It makes it a little harder to run the company. So people sleep better who don't have debt.
correct.
They sleep better. So
Along the same lines, we also see companies where cat work and large loss is like 90% of the revenue. I'm exaggerating, right? But it's a major part of the revenue.
right.
And I've never seen more stressed out owners than someone with that business model.
Do you remember? Do you remember? So it's like I think it was 2005. We had 5 hurricanes come through,
Yeah,
and I
yeah,
think it was 10 years after that, not a single hurricane hit the United States.
correct.
A couple tropical storms, but there was some big companies that went out of business because they were built on something, an act of God happening that doesn't always happen. And
Correct.
so, the stories you read the news, and it's hey, it's we've got this changing world, and there's going to be more hurricanes, there's going to be more extreme, and that's a bad that's really running your business through hope and not having a really solid strategy. And so here, as we look at, I'm just going to say, debt creates risk in your business. It allows you to take somebody else's money and leverage into your company. So there's positives and negatives to both of it. We get paid in 45 days if we're really good on our collections. We pay our bills out in every week to every 30 days. Depends on how you're set up. There's a 15-day float on most people's cash. Nice to have a bank line to support that. But it's tough to say that's 100% how I'm going to run my company. And
Yeah.
so it's important to have kind of have balance. I think every company needs to have the backing of a line of credit to help them as they grow their business. But to be dependent on that day in and day out is scary. So
It is scary, and we talked about. So let's talk about what we can do, right? And let's talk about some of the best practices in our industry that you see. We were just talking about, and like you to talk about it some more. Right before we started recording, we were talking about taking the net income and then building everything backwards from there, right?
perfect. Yeah.
Let's
Yeah.
dive into that a little bit. Yeah.
Okay. So the first thing is this. What are we doing this for? Part of it we get esteem. We feel good about. We feel good about helping people in their time of need. But if we're not making profits, we really don't have a good strategy for long-term success in our business. And so we need to be profitable. We need to be cash positive. And so the very first way to do that is start looking and saying, okay, what do I need at the end of the day? And the first thing I'm going to say is there's a lot of companies operating at 2 to 4% net profit, and I'm gonna tell you those people are basically they're walking dead.
Yeah.
They're statistically broke because there's all this stuff that doesn't hit the P&L that's on your balance sheet that are costs of cash in the company, and those companies are just bleeding themselves dry. So you need to have a realistic number that says this is sustainable. I can create a cash positive, successful business that can help that can help through good times and bad times. So a net profit number should be at least 7, and probably frankly you need to be at least 10%. you need to be 10% in your company. So start out with a net profit number of 10%. Maybe it's 12, maybe it's 20. I've talked to companies that are over 30%. So
Yeah.
where is your number? Start with that first. You
I
have a
did one
really
today at
good
23 and change percent. Healthy.
yeah. So you have a really good idea what your net or your overhead is. Your overhead's built in. You can manage that. But what is it today? Well, no, let's go back the other way. So we have net profit. We know what our gross margin is. We know what our gross margin is because we know we're going to make 40% on our recon. We're going to make 60% on our contents, on our mold, and our mitigation is higher. So we know what our gross margin is. We can fill our overhead in between there and say, okay, what do we need? What can we afford to spend on? There's some things that are fixed. There's some things that are discretionary in our overhead. But we built it backwards. Start with net profit. We know our gross profit. Then we fill in our overhead in between here, and that gets us where we need to be. So we can create it on paper, and then work towards executing that. And when we see a statement, we can look back and say, okay, what happened? Why did my numbers not work out where they should? Because we had it planned. We looked at it. So now we can effectively manage our business. We can strategically and deliberately be in control of the numbers that we have, the profit we have, the value in our company, and ultimately the cash we can spend out of it to either reward ourselves or to minimize risk in the company or to pay bonuses or to buy new things.
It's funny, we're doing the last episode on the 4-part series, and we saved the best for last, I feel, because you got to plan the work and then work the plan, correct? And I don't know if you see it, but in my firm, I see people that have the discipline of putting a budget out for the year and a forecast, right? All the budget, HR, payroll, what are my resources? If I'm going to grow 20%, what is that going to take in payroll, expenses, infrastructure, equipment, all this, where they lay out a plan. Whether they stick to it to a T or not is irrelevant to me, but just laying out that plan and looking at it periodically, like I look at mine every quarter, but I notice that firms that come to us that have that discipline of doing it have much higher margins than companies that don't.
Absolutely. So the first thing that happens is people say, I can't make plans because I don't know when the storm's going to hit. I can't because, and so people, what they do is they throw themselves in chaos because they say we're a chaos business. So they create that own reality for themselves. Here's an interesting little statistic, or not statistic, just something I found in my 25 years in consulting and probably 35 years in restoration. If you create a goal and an expectation, you measure it on a monthly basis for a revenue number. Say, okay, I'm going to do this much every month. And then you measure, and then you every week, and you say, how are we doing towards our goal achievement? You'll find that your sales tend to kind of do this. That was a straight line.
That's interesting. That's interesting.
So what it allows us to do is have some level of predictability in our business. And once we do this and measure it for quite a while, we can actually do quarterly variations. We have busy seasons and slow seasons. But here's my let's talk about averages. I have a theory on the law of averages. You put a foot in a bucket of ice water and you put another foot in a bucket of boiling water. On average, it's pretty uncomfortable, but I bet you it's about 86 degrees or something like that. So what it allows, there are averages that we can manage off of, and we can take a look at our numbers and we can have some understanding and feeling about it. So look at your numbers and know where they come from. Be predictable. Be predictable. They will help you be predictable and understand where the variances come into it, and then have a strategy for adjusting that. But look at your numbers. I talked to a guy today. He says, well, I don't have my April numbers yet, but today's Friday, so I'll have them by the end of the afternoon. It's May 5th. So he's got his May numbers or his April numbers, and he knows how he did, so he can adjust and track and manage. So, I always look at
it's such a simple thing. Let's expand on that for a minute, right? Okay. So, me included, last year I got undisciplined in looking at my financials periodically. And listen, we're not perfect here at all. So I want to share this story. Got really undisciplined doing it. And towards the end of the year, yes, we hit some of our numbers, could have been better. But I looked in the mirror and was like, shame on me, man. I mean, like, I know better, right, than to do that. And I'm growing my business. We've quadrupled in the last 4 years. So we're growing really fast. So I just got pulled in a lot of directions last year. And what I did this year was I have a bookkeeper, that does my QuickBooks for me. And I did a real simple thing, and boy, did it work. Every week on Monday, right after my staff meeting, I meet with my bookkeeper for 30 minutes. Right? I just put it on my calendar because if it's not scheduled, especially for really busy entrepreneurs, as we're building our business, if it's not scheduled, it doesn't exist, right?
Yep.
So I put a 30-minute meeting every Monday, and now my financials are good week to week to week, and it helps me sleep at night much better.
Right.
So anyway, it's a strategy that worked for us.
So I'm going to do some in a restoration company. If you're looking at your P&L on a weekly basis in a restoration company, it's going to go like this. It's going to be just back and forth and up and down,
Yeah.
and so it'll drive you crazy. From in a restoration company, my advice is get your statements as fast as you can at the end of the month, or so be the beginning of the following month. But so I look at records in accountability and accounting in a company is we have windshield reports and we have rear view mirror reports. And so the windshield report tells me where I'm going. Rear view mirror tells me where I've been. And that's my financial statements. I can't impact them after they're done, but I can
Yeah.
look and say, do they make sense to me? So my windshield, which creates those that I can look at on a daily basis and have really accurate numbers. What's my invoicing? How much did I invoice? What are my job cost numbers? How are my profitability on jobs going? What's my new signed contracts? Because I can figure out how long it takes for that to turn into cash in my company. What is so we talk about profitability sales, invoicing, turns on receivables, all this stuff that you can look at on a weekly basis that will create your financials. And your financials should only be a verification of what you thought you were going to see. And when they're not a verification of what you thought you were going to see, you better go look at your inputs. First of all, the question I'm going to have is, did my financials make sense? And if they didn't, then I can maybe go in and diagnose why. So one of the things I look at financials and financial reporting as windshield reports and rearview mirror reports. And when I'm looking at financial statements, even if it's on the fifth of the following month, it's only looking and verifying where I was. What I want to do on a daily basis is I want to look and see where I'm going, and it's what my financial statements are going to look like. So the things I'm watching on my windshield, it's going to be my invoicing, my job costing, my sales, like my new signed contracts, profitability reports, my job costing reports. All of this stuff is going to tell me what my financial statements will look like at the end of or at the beginning of the next month. And so
Yeah.
I can verify that my financial reports look like all of my windshield reports that I saw when I was looking at where I was going. And so in restoration, maybe I'm not looking at my P&L on a weekly basis because my invoicing doesn't align with my costs, and there's all
Sure.
sorts of things that are kind of that complicate it. But if I look at my windshield reports, and I should be looking at those very, very consistently, because that's what I can effectively, proactively manage to create my net profit that we planned previously when we said, here's my financial statements. Here's what it's going to look like. Now let's go make it.
So you just dropped a nugget there, right? I mean, it's like the rear view mirror reports and the windshield reports. It's really interesting how you framed it, right? Like the P&Ls are just a reflection of what you anticipated was going to happen. It is
Right.
not the real thing, right? Most of us think of P&Ls as the one document,
Yeah.
right?
Yeah.
So,
I just talked with somebody at the most recent conference I was at, and they have over 35 different reports that they're looking at on a daily basis in their company. And so everybody is accountable to some numbers. Those are big numbers. And I challenge them. I'm like, man, when you have too many, how do you effectively manage them? He says, everybody's got their own that they focus on, and together it gets us over 35 things that we're looking at on a daily basis. I think it's too many, but if every person's looking at 4 or 5 at the most, maybe not. So, but have good measurements in your company so you can have accountability and you can have, let's say, awareness of what's happening. Is, people who don't have those things, here's a test for you in your company. Do you find yourself saying, I think we're doing well, I feel like things are not so good, I kind of think we're doing well? If you're saying those things, it's because you don't have quantifiable measurements in your company, and everything that you're doing is very subjective. So when you have objective measurements, you now can manage out of confidence.
That's great. So let's say somebody's listening to this and they feel like the company is doing well, but they don't know really how. Where would you start, Phil? Where would you start? They're driving in their truck, they're driving whatever home between jobs, they're listening to this podcast.
Yep.
Something resonates with them. Where do you start? And then I'll have a follow-up question to that. If maybe they have gone down the road a little bit, what are some of the reports that they should be looking at
Sure.
on a monthly and a quarterly basis?
Okay. A lot of people don't pay attention to their office. They don't pay attention to the number. They don't pay attention to having the right bookkeeper for the place they are in their company at that time in their company. It's a very, very vital position because everything else builds off of the activities and the things that they're doing. So number one thing you have to do, make sure you have a really good, solid bookkeeper in your company. And if it's just you like that person or you're married to that person, then if that's the case, make sure they have the training they need in order to effectively do their job. Have a really good CPA that can help you with that process to help manage your numbers. Your numbers are vital to, when you go to the doctor's office, the first thing they do is put a cuff on your arm and they check your blood pressure. They check your pulse. They check your vitals before they do anything else. What do you do in your business? What are your vital statistics? You have to be able to check those, but they have to be accurate in real numbers. So make sure you have a good way to report and track those things. And the one thing that I found is there's, as you're growing, let's say a company's growing so rapidly, it's tough to get good historical numbers. Then figure out the inputs to them. What are your job costing numbers? What are your sales numbers? It's these windshield stuff that is important that you generally would understand. You can figure your break even from that. You can figure out how much money you're going to be bringing in the door to make sure you're paying the bills. So get the good quantifiable numbers on the things you can get today, and then work towards refining and getting great P&L numbers. But at the very minimum, I need to know my job costs. I need to know my cash statement. How much am I spending versus how much am I bringing in? People that don't have really good numbers, they do a weekly cash number. Like, what's my money out? What's my money in? It's a difficult thing because there's some guessing and projections within it.
Sure.
But if you are running a cash poor business, you need to do that. So look at the inputs as much as the outputs. So we're talking about the rearview mirror stuff. That's important, but the stuff that's essential is the windshield stuff. And if the very first thing you do, know my job costing numbers, know my invoicing numbers, know my collections, and then know my money in versus money out.
That's perfect, man. A lot of great nuggets. And here's my second question as a follow-up to it, right? So if somebody has someone, let's say they have a bookkeeper, they got an accountant, what reports should they be looking at to squeeze the most juice out of every dollar of revenue? I don't know, let's say on a monthly basis, on a quarterly basis, what would be like your top 2 or 3 reports that someone should be looking for?
I'm gonna go. They're very fundamental. We need a job costing report. We have to know how much money we're making on the job. Let's talk about financial reports. The 2 gold standards. We need a P&L, profit and loss report, and it's an accrued revenue and accrued cost statement. That's going to tell me where we spend our money and how we got our money in the last month. That's very important. And then the balance sheet, because I tell you what, if you have a balance sheet, it needs to tie to your P&L. You should be able to see cash working through your company. If it was profits, where are they on the balance sheet? Is it sitting in accounts receivable? Do we buy assets? Do we pay distributions? It's all there. It's the rest of the story. So you need to have both of those reports, and then a statement of cash flow. It's going to tell you where your starting money was and your ending money, and that'll tell you a whole lot about how your operation's rolling.
Man, there's some great nuggets. I know we can talk for another hour on this. I like to keep this around 12 to 15 minutes. We could go on till the sun goes down and geek out on this stuff. But listen, Phil, this is our 4th episode and kind of squeezing the most out of your business. thanks for coming on and kind of telling us some of what you see with 35 years of experience and all the businesses that Business Mentors has seen. And I hate to say you've seen everything, right? Because the minute you say that, you see something new. But you've seen just about everything. Let's put it that way. So, so hey, thanks a lot for coming on, man. I really appreciate it.
I appreciate you having me.
All
Thank
right,
you.
buddy. Thanks.
You've been listening to Let's Go with Gokul Padmanabhan, a thoughtful listen on creating your business legacy. Subscribe on your preferred podcast app so you don't miss an episode. And if you like what you're hearing, please rate and review. Thanks for listening.